Welcome, everyone. This is episode 2 in our talks on finance for startups and entrepreneurs. I'm Donny from Six Berries, and we have Ted from Talk Financials, and we're here to answer your questions and just talk around finance and what it is, how you do it, and to answer any questions that people have. So, Ted, how's it going?
It's good, Donny. It's good. How are you?
Yeah, not too bad, thanks. Last time we covered how to set up a company, and you just want to take a big leap of starting your own business. So we spoke about how to set up your company. So what are we going to talk about today, Ted?
Okay, so you're absolutely right, Donny. So last time we talked about how to set up your business, whether you're a sole trader, a partnership, a limited liability partnership, or a limited company. And what we're going to do now is we're going to assume that you've set up your business, and we're going to really focus on a limited company because that's probably the most common structure of a company. And we're going to talk about, well, how are you going to fund your business? So let me just share my screen with you, Donny. Here it comes. So hopefully you can see the slides.
Really important.
Hopefully you can see that.
We can see the slides.
Okay, so all about how to fund the business. And really, there are two main sources of funding. But let's first of all think about when we talked about structuring the business, Donny, if you remember, we issued a share and we said that every company has to issue at least one share, and that share has to have a numerical value. And it could just be one share for 1p or 1 million shares at $1 million each, for example. So every company has to start off by raising cash. And we use that cash then to buy assets. Now, in my example here, Donny, we're going to buy Battersea Power Station, an iconic building here in southwest London. Can you name the album on which Battersea Power Station appears, Donny? Can you name the album?
I cannot name the album.
Okay, that shows a distinct lack of knowledge of music. It is, of course, Pink Floyd, Animals, a great album, but a little bit dated maybe. Now, Battersea Power Station, Donny, it used to be a power station, but obviously with the Clean Air Act in London many years ago, it was closed down, and it's now been turned into residential apartments. Now, Donny, you could be the proud owner of a one-bedroom apartment in Battersea Power Station. Can you have a guess as to how much it's on the market for? One-bedroom apartment in Battersea Power Station.
I don't want to guess. I would guess north of $1 million. Is it north of $1 million?
It is north of $1 million, because if you paid £1 million for it, Donny, you'd only get half of the apartment. It's on the market for £2 million. A bargain. Buy now while stocks last. So maybe you're thinking like I am, that we're not going to buy an apartment in Battersea Power Station. Anyway, the point here is we raise money, we buy assets, we use those assets to trade and to make a profit, and that profit we then turn into cash. And there are two things we can do with that cash, Donny. What can we do with the profit or the cash left over?
We can either spend it or invest it back into the company.
Well, that's kind of the same thing. Spending it is investing it. So the answer is that either we can reinvest it, which allows us to buy more assets to make more profits in the future, or we can return it to the investors. Okay? So raising cash, what are the two primary sources of cash available to a business?
I think I know this. Is it debt and equity?
You're absolutely right, Donny. It is, of course, debt and equity, the two main sources. And debt and equity together makes what we call the capital employed in a business. So when people are talking about capital or capital employed, they're talking about the debt and the equity together. Now, quick caveat, Donny, you may get other sources of income. So you might be able to get a local grant, for example, a startup fund, et cetera, from the local authority or from the government. And those are all outside of any grants. So there are the options for grants, et cetera. But what we're really going to do in this session is focus on debt and equity. Okay?
So Ted, just on that point with grants and stuff like that, is the distinction there is that you don't have to give the money back, or that's given to the company, and the money doesn't necessarily have to be repaid, or you don't have to give anything for it, correct?
It kind of depends on the grant. So grants are often there in order to help small business to start up, because the small business of today turns into the big business of tomorrow. So there's an incentive for governments to encourage entrepreneurs, to encourage local and small businesses to grow and to flourish. And it really comes down to the terms of that grant. Some of them will be an interest-free loan, perhaps. Some of them may be not repayable, maybe just a gift. Some of them may be repayable at some point in the future. And depending on the nature of the grant, depends on obviously how you're going to treat it.
Right. Okay.
Okay, so debt and equity, two primary sources of capital available to a business. Donnie, we're going to start off with debt because you're probably more familiar with debt, and debt comes in the form of a loan. Now, Donnie, if I lend you some money, I'm going to want a reward for lending you that money. How do I get rewarded?
So I pay interest on the amount that you give to me.
So you're going to pay an interest on it, and the interest you pay is compulsory. Donnie, you have to pay it. If you don't believe me, phone up your mortgage company, tell them you're not paying the interest on the mortgage, and see how much trouble you get yourself into. Okay, so this is why debt is often referred to as fixed income. So fixed income means it's fixed. For me, the debt provider, the lender, the income, the interest I receive is fixed. Now, the capital is also repayable. Now, this might be news to a few people in the UK, Donnie, who are on their interest-only mortgages. The money you've borrowed, you're going to have to give back. And it may also be secured. Now, if I lend you money, Donnie, and I secure it on an asset, what happens to risk to me, the lender?
Well, I mean, if I can't pay it back, you just seize the asset.
Exactly. So what happens to the risk of exposure to me? Is it up or down?
It's down.
It's down. You're absolutely right. So if I lend you money and I secure it on an asset, it's a lower risk to me, the lender. What implication does that have on the rate of interest I'm going to charge you, Donnie?
Well, you should be able to charge me a lower interest rate.
Absolutely.
Lower risk.
You're absolutely right. And so what we see now here is a very important relationship between risk and return. If I lend you money like a mortgage, Donnie, which is secured on your house, which means if you do not keep up repayments on your mortgage, then I will take ownership of your house. It's a lower risk to me, the lender, and therefore I will charge you a lower rate of interest, typically 2 or 3% in the current environment. Your credit card, Donnie, is an unsecured loan. And therefore, because it's unsecured, it's higher risk to the lender, and therefore they're going to charge you a higher rate of interest, typically 20 or 30% in today's environment. Donnie, do you remember a company called Wonga?
Yes, I remember, and they charged 23,000% or something like that.
So Wonga actually charged 5,843% rate of interest, which is almost immoral. But luckily, we're talking here about business finance, not business ethics, Donnie. And the reason that Wonga were charging such a high rate of interest is they're a payday company, and they were lending to people who had no job, no income, no credit history, who were at a very high risk of default. Effectively, they're the next thing to loan sharks. Okay, yeah. So Donnie, in summary, debt. If I lend you money, my two primary concerns are: one, can you service the debt? Can you pay the interest? And two, can you repay the capital? Both are important, Donnie, but which is more important, do you think?
The capital. Can you repay the capital?
It's a good guess, Donnie, but I'm going to give you another chance to have another guess.
Pay the interest.
It is the interest. You're absolutely right. Well done, Donnie. But don't worry, lots of people will say the capital. It's actually the interest for a business, because as long as you can service the debt, as long as you can repay, as long as you can pay the interest, it allows you to refinance or to borrow money over here to repay money over here. So lots of companies, like if you look at Coca-Cola's companies, for example, they're refinancing every single year. They're borrowing money over here to repay money over here.
Right.
Now, Important distinction here, Donnie, between you and me and a company. Okay, so what we should be doing is trying not to refinance. If I borrow money to buy a house, I should be aiming to be debt free by the time I retire. Okay, theoretically. But don't forget, a company is what's known as a going concern. It's trading and is expected to continue to trade for the foreseeable future, basically forever. And therefore, a company will say, if I can borrow money over here at, say, 5%, and I can invest it and generate a return at 10%, why use spare money to pay down debt that costs me 5% when actually I can invest it and generate 10%? Okay, so companies will think about debt in a slightly different way to you or me, to an individual. Okay. Debt. Everyone, are you happy with debt, Donnie?
Yeah. That bit about the interest and refinancing is quite interesting. I never thought about it like that.
Excellent. Okay. So you may not be happy with debt, but we're happy with the concept of debt. So let's come on to looking at equity. So equity is where you're buying a share in the business. As a shareholder, you become a part owner of that business. What income does the shareholder receive?
Dividends, if there's a profit.
Absolutely. So the shareholder will receive the dividend. Now, who sets the dividend, Donnie?
The board.
The board of directors, correct. Okay. Yes. So here's the difference. The lender, if I'm a lender to you, Donnie, I will decide the rate of interest. But I invest in your business and you are the director, you decide on how much dividend, if any, you're going to pay me. Okay, important distinction here. So it's a variable income for the investor. The capital invested is non-repayable. Okay, so this amount of money that we invest, that we buy the shares, this is non-repayable by the company until the company goes into liquidation. Okay, now the company can buy your shares back from you, but that's not quite the same thing. Okay, so let's take an example of this. I want you to come back with me in time, Donnie, all the way back to 1973. 1973 period of very high inflation, but out of the ashes of the kind of the turmoil was born a very small company called Microsoft. And I want you to imagine that we've been sitting in a garden in California. We've got $10,000 to invest. We're not sure where to invest it. We found out about our friend who started a company down the road in his mum's garage. It's called Microsoft. We invest $10,000 into Microsoft. Okay, you with me so far?
Yep.
So Microsoft did not pay a dividend for 30 years. Okay, so the first dividend payment by Microsoft was made in 2003. Okay, that's the first thing to remember. The second thing to remember is that you're only going to get your $10,000 back from Microsoft when it goes into liquidation. And the last time I looked, Microsoft is a very successful company and will continue to be trading long after you and I are pushing daisies, Donnie. Okay, so Microsoft is not going to go into liquidation. You're not going to get your money back, and we haven't received any income, any dividend for 30 years. So I want you now to imagine it's the year 2000. It's 27 years after your investment. And you're looking through your list of investments, and you notice this one in Microsoft, no income at all for 27 years, and you're never going to get your money back. How happy would you be with your investment in Microsoft, Donnie?
Probably not happy if you just look at it like that.
Donnie, you would not be sitting in that room there if you'd put $10,000 into Microsoft when it started. Where would you be sitting right now?
In a mansion somewhere.
In a mansion. Yeah, probably on an island. And you own the island.
Yeah.
Why? Why do you say that, Donnie?
Well, because the value of the share would have gone up.
Absolutely. So the value of Microsoft shares has gone up. And who sets the value of Microsoft shares?
That's a good question. Who sets the value of Microsoft shares? If it's traded on the exchange, right? It's how much somebody's willing to pay for that share.
Exactly. It's the market, Donnie. The market sets the value of Microsoft shares. And if everybody wants to buy shares in Microsoft, the share price goes up. And if everybody wants to sell shares, the share price goes down. Okay. And as you mentioned, Microsoft is traded on the market, it's traded on the NASDAQ, which means you and I can buy shares in Microsoft today if we so wish. So let's say, for example, we're going to buy a share in Microsoft. We're going to pay, I don't know, whatever it's trading at today. I haven't had a look. Let's say it's $100 to keep it easy. So we phone up our stockbroker and we shout, Microsoft, buy, buy, buy. I mean, we can do it on the internet these days, but it's more fun if you do it on the phone because you get to sound like a real trader. So we shout, Microsoft, buy, buy, buy. Approximately how much, Donny, of that $100 we pay for the share does Microsoft receive?
Well, the broker will take some of that money.
Yeah.
And I'm guessing the rest of it.
Okay, so how much? Give me
so $90. I don't know what the brokers will charge. Less than that. $50. $20. $1. Zero.
Zero. Absolutely right. Zero. Why? Because when you phone up your stockbroker and shout Microsoft buy, 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 somebody else somewhere else in the world phones up their stockbroker and shouts sell, sell, sell. The trade is completed independently of Microsoft. Microsoft only received the money when they sold the shares in the first place back in 1973 for $10,000. Okay. So very important. So when we talk about, buying and selling shares, we're buying and selling them on what we call the secondary market. The primary market is where a company raises debt or equity. Okay. The secondary market is where you and I trade that debt or equity. A little bit like the second-hand car market. Do you have a car, Donny?
Yeah, I do.
What make is it?
Nissan.
Nissan. Okay, so Donny, if you were to sell me your Nissan car for £50, and I'm not saying it's worth £50, Donny, by the way, but if you were to sell it to me, but if you were to sell it to me for £50, how much of that £50 would you give to Nissan?
Zero.
Exactly. So Nissan only make the money when they sell the car in the first instance, and thereafter on the second-hand car market, they don't see any of the money. It's just traded, and that's exactly the same as shares. Okay.
Right.
So if you want
to clarify that, so sorry, Ted.
No, go on.
One question there. So if I, as a company, I am issuing shares and I'm selling it, so when I'm raising capital, I would give these shares away. That's when I get the money. But then
you wouldn't give them away. You'd sell them.
You sell them. Sorry. But then once I've sold those shares, there might be an option for the shareholder to then trade that share to somebody else.
Absolutely.
Even if it's not traded on the stock market, correct?
Correct. Yes. So you raise a very important one, Donny. So if you and I set up a business and you own one share and I own one share, and then you lose interest and say, actually, I'm going to sell my share to some bloke I met down the pub, suddenly I'm in business with somebody I don't know.
Yeah.
And we mentioned earlier about a shareholders agreement. We're going to talk about that in a little bit more detail. A shareholders agreement is really, really important. If you and I go into business together, we need a shareholders agreement that says, what if I want to sell my share? Do I have to sell it to you? Can I sell it to somebody else, for example? Okay, so very, very important, and a good point that you raised there.
Yeah. Yes.
So let's say you and I set up our own business. We're talking here obviously about funding small businesses. Let's say we set up I don't know, coffee shop up the road, and you own 50% and I own 50%. And then you decide that actually you don't want you don't want your share anymore. You phone up your stockbroker and you shout, Donny's coffee shop, buy, buy, buy. In fact, no, we had Ted's veg shop, didn't we? It's Ted's vegetables. Okay, so you phone up your stockbroker and shout, Ted's veg, sell, sell, sell. What do you think your stockbroker's going to say?
I don't know who Ted's veg is.
Exactly, because you're not a listed company.
Yeah.
Okay. And so therefore, for an equity investor, it's very important to consider what we call liquidity. And liquidity is the ability to turn something into cash. So if you own a share in Microsoft, it's very easy to turn it into cash. You can sell it just like that. Sell, sell, sell. If you own a share in Ted's Veg, it's very difficult to sell because it's an unlisted company. And if something is more difficult to sell, it makes it higher risk. And if it's higher risk, Donny, what are you going to demand in terms of a return?
High interest.
well, not interest, a higher
Okay.
rate of return.
Yeah,
Okay.
higher return.
So you're starting to think about, so if I'm investing in a new business or a startup, it's going to be inherently higher risk. And therefore, as an equity investor, I'm going to demand a higher rate of return.
Yeah.
Okay. So everything clear on that?
Yeah,
okay.
yeah. No,
So
all good.
just to summarize, the concern of the debt investor is, can you service my debt? Can you afford the interest payments, and can you repay the capital, or do I have the security to get the money back, or can you refinance? So are you comfortable you're able to pay your interest payments, and therefore you can refinance? And a good example of this would be Thomas Cook, for example. Thomas Cook had too much debt, the interest was too high, they couldn't pay the interest, therefore they couldn't refinance. And when the debt investors said, we want our money back, Thomas Cook said, we can't give it back to you, and the company collapsed. Okay, so it happens. On the other side, for the equity investor, it's not about refinancing, it's, am I going to get any dividend? And not, am I going to get my money back, but how do I get out? What's my exit strategy? Okay, so again, Donnie, really, really important that if you and I go into business together and set up Ted's Veg, and my intention is to run this for 20 years and then hand it on to my kids and my grandkids, etc., and your intention is to make a quick buck and get out in 3 years, we're coming at this from different angles. I've got a long-term exit strategy, you've got a short-term exit strategy. We need to have those conversations before we get in.
Yeah.
Okay.
I think it's an important thing for people starting up their business, because I hear a lot of startups who come in and investors do ask that question. So they ask them, what's your goals for the company? And a lot of businesses aren't very clear on that. They're not clear whether they want to make this a big business and work with it for 20, 25 years and then pass it over to somebody else and have it going, or whether they think that they can exit in 5, 10 years. And that's a big question mark with investors, right? They want to know how they're going to get their money back.
So if you start to think about this, so the debt is quite arm's length. The debt is, it's a bank manager who just lends you the money, says, just pay the interest and give me my money back when, and I'll leave you alone. A little bit like when you buy a mortgage. But the equity, this is going to be a much closer relationship. So you might have business angels. If you're very, very early startup, you might be talking to business angels. You might start to talk to venture capitalists. You might have a number of venture capitalists who are going to actually start to fund you. And it's really important that not only are you trying to raise money for your business, but don't forget, from their perspective, they're looking for a return. They're looking for a good opportunity. They're looking for a good return with lower risk. And you need to make sure that you're compatible, that your objectives are the same. So if a venture capital, if a business angel comes in and says, look, I'm looking to get out in three years, for example, and I'm going to sell onto a venture capitalist, you need to say, well, I need to make sure that the venture capitalist and I are compatible. And the venture capitalist, typically they'll have a time horizon of maybe 5 to 7 years. Typically, they don't really want to be tying their money up for much longer than that. So 5 to 7 years, you need to make sure that that's your time horizon as well, because otherwise you're going to have a lot of boardroom battles and a lot of issues with your shareholders. Worth just stating here, you remember when we talked about the structure of the company, so the shareholder isn't necessarily a director. Okay. Yes. So if I'm sitting with you, Donnie, and you come to me and you say, Ted, will you become will you be an equity investor and buy 40% of my business? What I will probably want to do is to appoint myself or a representative to the board as an investor director. Okay. Now, you may remember that when we talked about the structure, we talked about executive and non-executive directors. So typically, a venture capitalist will appoint a non-executive or an investor director. They're not responsible for the day-to-day operation of the business, but they sit on the board and they can influence the decision-making as a result. Because otherwise they sit outside and they have no influence. So again, you're starting to think about the terms of any equity investment. People might say, yes, I will put an investment in, but I need a seat on the board as a result. And then you've got, you've got personality clashes, you've got compatibility issues, and it can cause lots and lots of aggravation. So you need to go into this really eyes wide open, if that makes sense.
Yeah, no, completely. I think this is one of the things that a lot of, again, startups and early stage startups, they don't understand about how, when you raise capital by equity, and you have shareholders on your system, how that kind of cascades. So what are the things that it raises? So yes, you get the money, but now you have somebody who wants to try and influence that business. So making sure that you have that compatibility at the start is very important. And again, a lot of just for startups and for the benefits of founders out there who haven't done it before, it's a two-way street, right? So you want to get the money from the investors, which is important to you, but also it's them being able to provide a value if they want to be, if they want to be part of the journey, or if they don't just want to give you the money and go away, then that's fine. But I think it's important for to realize that it's not a one-way thing. You're not going out there with your hands out begging for money only. You want to make sure that it's a good relationship.
You'd be very, very unlikely to find an investor who'll just give you the money and go away. So most investors, I'm talking about substantial investors, if they give you a lot of money, they're going to be actively involved. They're going to want to see a return on that investment. And I think you're absolutely right. It's very easy for me to go into a negotiation and think, what do I want to out of it as a small business owner? I need the money. But sometimes we need to sit on the other side of the table and say, well, what do they want out of it? Why are they invested? Why are they keen in my product, in my service? What do they see as the potential?
Yeah.
And again, you can see that if you watch The Dragon's Den, and I'm not suggesting that's, the perfect example, but, often you see The Dragon's Den, the dragons are going, no, this is not interesting. You can see when they're interested. You can see when it switches and they go, actually, you know what? There's a potential here. Okay. And at that point, you need to sort of be able to read the negotiation power and think about, what is it that you as a business owner want from the relationship? Do you want their expertise, their knowledge, their contacts, their funds? How much involvement do you want? And this is all got to be set out, because if you assume, then you'll be found wanting. Okay. So you've got to articulate it right at the beginning and really get a good shareholders agreement set up front. Yeah. Donnie, I'm just going to finish this session talking a little bit about risk and summarizing risk. Okay, so what we've talked about is the two sources of funding available to a business, which are both debt and equity. And we're looking at this from the investor's perspective and from the company's perspective. From the investor's perspective, as we discussed, equity is higher risk. And because it's higher risk, the equity investor demands a higher rate of return. Okay, now that might not be in the physical dividends. Don't forget, if Elon Musk had come to you when he was starting Tesla and said, I need $100, will you lend it to me? And you lent it to him at 10%. If you'd said, actually, Elon, I'll give you $100, but I want 50% of the company, your return would have been very, very substantial, obviously. Okay, so you're starting to think about this sort of high risk, high return. And on the debt side, because to the investor it's lower risk, it's therefore going to be lower return to the investor. Okay. So from the company's perspective, equity is lower risk because you don't have to pay dividends and you don't have to give the money back. So you can just take the money in and have a go. Okay. So it's much, much lower risk. But because the investor demands a higher rate of return, you're going to find that equity is more expensive to the company. And therefore, debt is higher risk. You have to pay the interest. You have to repay the capital or to refinance. But because the investor demands a lower rate of return, you're going to find that it's actually cheaper. And there's also a tax advantage to debt as well. But that's something we're going to cover in another session.
Yep.
So, Donnie, hopefully that summarizes what we've actually been talking about in terms of, the two main sources of finance, which are debt and equity. Debt is a higher risk to the company, and equity is lower risk. And if you're going to go down the equity, you also want to think not only about the financial risk, but also the relationship risk. Okay, so that you're getting into bed with new partners, and you need to make sure that your goals are aligned, your financial goals, your operational, your core values, your ethics, all of that have got to be sorted out up front, because otherwise you can end up with a really nasty, messy situation.
Yeah, no, I agreed. That was very, very useful, Ted, as always. I think we have some very exciting topics to cover. Now that we've kind of touched the surface on debt and equity, we're going to go into what a bit more detail about equity and shares and all that fun stuff, and then debt later on. So for anybody who's watching this video, we have some really exciting stuff coming up. So subscribe to the channel. Ted will post this video on the Talk Financials channel. So please do subscribe, and put in the comments below. Add any questions that you have. So if you have specific questions around funding the company or any other finance questions, please do feel free to add the comments, and we'll get them answered for you.
And absolutely, Donny, and also if there are any topics that you particularly want us to cover, anything got a burning issues, you're not quite sure about, I don't know, should I register for VAT, for example, or should I pay myself through a salary or through dividend, anything like that, just put it in the comments, and we'll make sure that if we haven't already got it on our list of topics that are coming up, then we can make sure that we cover them.
Yeah. Perfect. So thanks very much again, Ted.
Thank you, Donny. Great to speak to you again.
All right. So see you guys soon. Thanks.